In this video, let's compare some of the most popular YieldMax ETFs such as NVDY, YMAX and some others. YieldMax was making headlines with its ETFs that have a distribution yield topping 100% or sometimes even more. So let's see if this is a hype or a real thing. Also, by the end of the video, I will try to conclude if these ETFs are suitable for retirement.
First off, these funds are not cheap. They charge almost 1% in fees. YMAX has almost 1.3% fee. Returns vary from year to year, but fees are always subtracted regardless of performance. According to Morningstar, YieldMax one-stock ETFs are in the second costliest quintile. The YMAX ETF is in the most expensive quintile.
If you're watching this video, you're probably familiar with covered call funds, so I'm not gonna go into too much details in this video. In a nutshell, these funds, they trade price upside for a regular income by selling call options on an underlying asset.
In other words, if NVIDIA grows by almost 200%, NVDY total returns will be about 2 times smaller. But when NVIDIA goes down, NVIDIA will go down too, but to a less extent. This is because sold option premiums shield NVDY from full extent of downside. In return, you get regular income distributions. Like some other ETFs, YieldMax funds don't have a direct exposure to an underlying asset, meaning they don't buy stocks of NVIDIA, Tesla or Coinbase. Instead, they create a synthetic long exposure. They do so by buying call options and selling put options on NVIDIA and other stocks. This allows them to gain same exposure to stocks as if buying them directly. The benefit of synthetic exposure is higher leverage and lower capital commitment. Also, YieldMax funds use so-called flex options, which are customizable derivative contracts. The drawback of them is that they may have wider bid-ask spreads and higher trading costs.
When investing in a single stock fund like TSLY, an investor is making a bet on a single stock. And while NVIDIA rose due to AI trend, it's not clear if this is going to continue, especially these parabolic returns. So if I invested in these funds, I would make sure to understand them very well, and especially the companies that they invest in, like how likely they will outperform going forward and so on.
It is less of an urgency for YMAX. YMAX is a fund of funds. It invests in over 20 other YieldMax ETFs, including TSLY and NVDY on an equal weight basis. Each fund accounts for roughly 4% of YMAX assets, so in a sense YMAX is much more diversified compared to one-stock ETFs. All YieldMax funds boast massive distribution rates. NVDY almost 56%, TSLY 126%, CONY 89%, YMAX 60%. But these numbers are no more than the last distribution annualized. If we look at TSLY, for instance, we see a lot of fluctuations in distribution numbers. Here's the highest distribution per share in January of 2024. By doing simple annualizing, we get the yield of 61%. Conversely, we have the lowest distribution in June. Annualizing it, we get a yield of 52%. But notice that by June, while your yield was still within 50-60% range, the price declined by a whopping 32%. So in reality, if you bought TSLY back in January, your yield would not be 52%, it would be 35%. Pretty much the same is true for all other YieldMax ETFs. Their distributions show large swings from period to period. The reason is stock price volatility. For instance, if we look at NVDY, we see that its highest distributions happened in March and April. Looking at the NVIDIA chart, we see large price swings in those periods.
And this is generally true for covered call funds. Volatility is their friend. When the volatility spikes and there are wild swings in the stock price of the underlying asset, the stock options prices, they start to go up, and so when the fund sells the stock options, it earns large premium income. And the opposite is true. If the stock price goes sideways or does pretty much nothing with low volatility, the distribution yields for covered call funds can plummet by as much as 50%. And this is also true for YMAX ETF, as we see here.
If we look at other funds such as GEPQ, we also see fluctuations in distributions per share, but the swings are not as large as for YieldMax ETFs. The reason has to do again with volatility. GEPQ loosely tracks NASDAQ 100 with less volatility in mind. GEPQ yield is roughly 12%, which is much lower compared to YieldMax funds, but its distributions are more predictable. Also, GEPQ is less likely to show NAV erosion, which can be a big issue for YieldMax funds. I will talk about it in a second.
Well, there's nothing wrong with distributions fluctuating. I mean, this is how YieldMax ETFs are supposed to behave by their design. So if you're fine with that, then that's okay. But if I was someone nearing my retirement or in retirement, I think this would create a lot of headaches for me. Simply put, YieldMax ETFs would make my monthly budget planning very unpredictable.
The next thing to tackle is performance for YieldMax funds. Tesla was the worst Magnificent 7 performer in the last year or so. If we look at this total returns chart, here's what we see. When Tesla stock declined, TSLY declined by less, and when Tesla recovered, TSLY recovered by less. This is expected for covered call funds. Conversely, we have a big winner NVDY. Because of NVIDIA rise on AI trend, NVDY total returns have stood at almost 200% since its inception. This is by far the best performing YieldMax ETF, hands down. Again, comparing NVDY to NVIDIA, we see underperformance. The fund traded price upside for regular income as expected.
So if I'm a retiree or someone nearing my retirement, the question becomes, should I just load on NVDY and call it a day?
NVDY yield is massive. If I invested in NVDY at the beginning of this year, I would have gotten a distribution of $17.33. This has produced a yield of almost 80% on my stock price of $21.87. On top of that, the price appreciated by almost 15% by now.
Well, I don't know you, but my goal in retirement is to have a stable and reliable source of income if such a thing exists. The problem with these one-stock issuer funds by YieldMax is that they are like stock picking, and their performance is unpredictable and varies from one ETF to another. And I personally think that it's not a good idea to rely on stock picking in retirement to pay your monthly bills. These ETFs are undiversified and can crash, especially if you put everything into one fund. And in that scenario, the distribution yields can plummet very quickly. In my opinion, if I still wanted to put my funds into these one-stock ETFs by YieldMax, I would put something small in them. And on top of that, I would diversify these holdings by YieldMax with other funds.
YMAX fund is somewhat better in this regard. It bundles one-stock YieldMax ETFs into one product. Still, I see issues with it. First off, it's still less diversified compared to similar funds. Even though its allocation to a single stock is no more than 4 to 5%, it's still a lot. We may counter this with the fact that other funds can also be top-heavy. Take GEPQ, for instance. Its top 5 allocations are quite high, but after that they plummet below 2 to 3% as we see here. With YMAX, this is not the case. Allocations are equally weighted. This may expose the fund to a bad performance even from a few stocks.
But there is one thing where GEPQ and similar funds differ from YMAX. They follow some sort of more or less diversified index, for instance NASDAQ 100 or S&P 500. On top of that, S&P 500, for instance, they have stringent rules for profitability and liquidity of its stocks. And these indices, they weigh their stocks based on market cap. So if a stock starts to underperform and its market capitalization starts to go down, the index will drop it. Conversely, if a stock outperforms, its relative capitalization also grows, and its allocation may also increase within an index. So in other words, these indices, they reward winners and punish losers. And this partly explains why index ETFs are so popular. But this is not the case with YMAX. YMAX weighs everyone equally, regardless of whether it's a loser like TSLY or a winner like NVDY.
Another issue with any high-yield funds like YieldMax is this. Their total return numbers are meaningless if you don't reinvest distributions. Returns on Morningstar or Yahoo Finance are pre-tax with dividend reinvestment assumed. Many investors do not reinvest their dividends when it comes to high-yield funds. Here's a quick comparison of total returns with and without dividends reinvested since inception of these funds. Let's start with NVDY. The return with reinvestment is 205%. Without reinvestment, it is 140%. Next is CONY. With reinvestment, it's 91%. Without it is 78%. Next is TSLY. This one is ironic. An investor was better off not reinvesting distributions because TSLY price declined. As for YMAX, the difference is less pronounced. This is likely because the fund is new and not enough time has passed for the compounding effect to kick in.
So as we see, the differences in total returns can be dramatic, especially for high-yield funds. So this is something to keep in mind. Not reinvesting your dividends can skew results. Let's tackle another important issue for covered call funds, and that is a net asset value or NAV erosion. Net asset value of a fund is just its equity, and equity is equal to assets minus liabilities. The NAV of a fund can change to many factors, including people putting or withdrawing money from a fund. But when it comes to NAV per share, there are only two things that can change it, and these are investment gains or losses and distributions. And by the way, NAV per share is usually approximately equal to the price of a fund. The price and NAV per share can diverge here and there, but long term they should be equal to each other. So NAV erosion is just a fancy way of saying that the market price of a fund goes down.
Of course, NAV erosion can happen when a fund sustains large investment losses. But in case of covered call funds, this can happen when a fund distributes more than what it earned in a given period. For instance, in the case of TSLY, its price declined from $40 per share to $11 per share. This is a clear sign of NAV erosion. This happened because of the price declines of Tesla stock and continued distributions. The issue for TSLY was so severe that it even went through a reverse stock split. Funds like YieldMax are registered investment companies. By law, they must distribute at least 90% of their income to investors. So anytime they generate option premium income, they must distribute at least 90% of it to us. You can go and check YieldMax funds annual and half-annual reports to see it for yourself. Here's an income statement for TSLY. In 2023, TSLY racked up a bunch of realized losses as Tesla stock dropped. At the same time, TSLY continued distributing premium income to shareholders. For this reason, the bulk of the distributions were a return of capital for tax purposes.
Return of capital distributions are not taxable. Instead, they reduce the cost basis of an investment. So in a sense, it's like a tax-deferred gain. Later, once you sell your shares in an ETF, you will realize a higher capital gain on a lower cost basis. And it seems like the return of capital distributions are not a problem for funds such as NVDY, CONY or YMAX. So why is this discussion on NAV erosion important? Because once the price declines and there is no sign of recovery, there are problems ahead. First off, your initial investment in the fund gets a haircut. You will get a lower return on your initial investment because of the price decline. And second, most importantly, once the fund's price declines permanently, the fund will have to cut its distributions per share.
TSLY is a prime example of this. We see large NAV erosion as the price went down by more than 70%. This means that the fund at the end of the day distributed more than it earned with mounting losses. If we look at recent distributions from TSLY, we also see large declines. What's worse, if you invested in TSLY at the very beginning, your yield has dramatically decreased too. Thus, when when NAV erosion takes hold, a fund will have less capital to generate income and capital gains, and the next thing is plummeting yields. Of course, TSLY is the worst YieldMax fund to look at. Other funds such as NVDY were great, at least for now. But YMAX has seen some decrease in its price per share too. It's not clear if this is a permanent or temporary price decline. These funds can recover over time under favorable conditions. For this reason, it is best to assess NAV erosion by looking at longer periods, like several years.
The goal in retirement is to have a growing and sustainable dividend income. And you can have a stagnating or worse, declining dividend income. Otherwise, you will have a problem, especially if the inflation rate keeps growing. And a recent price spike underscored the importance of this. And what's worse, if NAV erosion takes hold, you cannot keep all of your distributions. You will have to reinvest at least part of them into either the same or a similar fund. When NAV erosion happens, most of the distributions from these funds will be return of capital. It's like a fund is giving my or your money back. Let's say I gave them $10, then they will start giving me my money back $1 at a time. And if the price never recovers, my distribution yield will plummet, and that's a problem in retirement.
To assess NAV erosion using a simple back-of-the-envelope method, start with a price chart. For instance, TSLY declined from $40 to $11. If you believe that this decline is permanent, you must reinvest at least $29 of your distributions. The ironic thing is that over the same period, TSLY distributed only $27, so you are short on $2. Looking at YMAX, things are not as bad. Still, there is some price decline. The price dropped by $2.50 since inception. The total distribution for the same period was $5.47. This means that you should reinvest at least $2.50 of your distributions to keep up with the NAV erosion. This is a rough and in no way precise way to figure this out. And of course, this could be a temporary decline and YMAX can recover. For this reason, it is best to look at longer periods of time. But we see that NAV erosion can be a real issue for YieldMax ETFs. Reinvesting distributions to counter price declines can lower income you get to keep. If I was someone in or nearing retirement, I would be hesitant to go heavy on one-stock YieldMax ETFs. They are like stock picking and are extremely risky. If you still want to invest in them, at least it is best to keep your allocations small. But what if I am young and have a job and bullish on stocks like NVIDIA or Tesla? In that case, why not invest in them directly? That way, I don't have to pay 1% fee to YieldMax and can potentially generate higher returns long term. On top of that, I won't have to pay distribution taxes each year if I have to hold these funds in a taxable account.
YMAX is of course better than TSLY or NVDY on a diversification criteria. Still, it's not as good as, say, other funds such as JPY or GPQ, and on top of that, you will still have to deal with swings in distributions. Also, you will have to keep an eye on NAV erosion, either from too many distributions or losses from underlying stocks. My feeling is that anytime a fund, especially covered call fund, has a distribution yield more than 20%, there's a substantial risk of NAV erosion. And for some reason, this is especially common among these funds that have a synthetic exposure, as opposed to buying stocks to get exposure to underlying assets. Overall, if you understand well what you're getting into, I don't think these funds are bad by themselves. I mean, clearly they have their own costs and benefits. The problem arises when people jump into these funds with no understanding of their risks. And YieldMax funds are not the type of set and forget it dividend fund. You will have to keep an eye on them. I hope this video was useful and will help you make a better decision for these funds. After all, deciding which ETFs to use in retirement is not something to take lightly. And also, please let me know what you think about YieldMax funds in retirement. Are they okay, suitable, or not? And as always, thank you so much for watching. Please like, subscribe and share this video, and I will see you next time.